Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please take your seats. Our program will begin now. Please welcome to the stage Rachel Lau, Managing Partner, RHL Ventures, and Esther Wong, Founder and CEO, 3 Capital Investment, for a conversation with Bloomberg's Venus Feng.
Welcome back, everyone. Hope you all just have a great lunch. We are very happy to have 2 speakers here to talk about the latest opportunities in artificial intelligence. So I would like to start to ask Rachel and Esther. We see OpenAI launched the ChatGPT 4.0 last month, and everyone was saying it's like the movie Her coming to reality. Have you have been trying this, or how do you see how far we are from a movie to reality?
So
maybe
I'll go
Esther.
ahead first. Okay, so for those of you who might know, I actually came from an industry background. So before I launched 3 Capital, I used to work for one of the largest AI company in Asia. So I was a founding member of the company, and I was in charge of investment. So think about it, that was 7 years ago. So 7 years ago, we were in the AI 1.0 era. What do we mean by that? AI 1.0 era is when you know that the thesis work, but the actual implementation is so costly that people don't have a sense of genuine direction where to go. So last week, when GPT-0 came out, I believe that we have, actually for the most part of last year, end of last year, we've entered the AI 2.0 era, where AI is truly being democratized. So people can actually, everybody, I'm sure all of us here have used AI already in our daily lives. And so it really helps to propagate the speed of AI. And I believe that apart from GPT-0, there will be other interesting players coming out as well.
Rachel?
So my name's Rachel. I'm based in Malaysia and Singapore. I mostly invest in Southeast Asia in both venture credit and equity and credit. And so over the last 7 years, we've been investing in a lot of AI. If you're talking about mind-blowing, sending people to the moon, her situations, I think we're a little bit further than what we think. But at the same time, we also see AI applications in autonomous vehicles. We see ChatGPT. I joke that it's now finally mass market because my mom writes it and uses ChatGPT for her speeches. And again, some of these things are more real-life application versus just in the background right now. And that's certainly been on the forefront of everybody's mind at this point. But again, I think we're much further than we think for robots taking over the world. But at the same time, we're much closer to real-life application in the long run.
Yeah. I think last year, 2023, we have been calling it as an explosive years of AI investment. So I have some number over here. According to PitchBook data, so it's like a record of more than 29 billion capital has been invested, more than almost 700 generative AI deals last year. And that's representing 268% increase of all the deals in 2022. So how do you two see the AI opportunities across Asia or globally?
So AI is such a broad term, but when we think about investment in AI, it's largely fall under 4 categories of AI that we can invest in, right? The fundamental elements of AI, so to speak. So we have, first of all, the data. What kind of data do we collect? The kind of data that we curate is quite important. So one of the biggest company in this sector is a company called Scale.ai. They recently just completed another $1 billion of fundraising. So that would be number one element. The number 2 element is the hardware side. So of course, all of you know of NVIDIA. But I also believe that there's a lot of interesting newcomer that may come potentially as a potential disruptor to this hardware sector. So that would be one. And I will include data center into the hardware side as well. The third element is the algorithm. So what's behind algorithm is human capital. So the world's most expensive, most valuable unlisted private companies are both, the top 3 all fall into this category. So you have OpenAI, you have Databricks, and these are all algorithm companies. And the fourth element is the feedback loop. This is where China can actually have a niche potentially over other countries, because we have a very, very quick feedback loop compared to the rest, but I can go into a little bit detail later on this sector. But when you think about these 4 different categories, as I said, potential initial stage of disruption would definitely come from the picks and shuffle. So I would say category 2. Okay, so in terms of data center and also in terms of potentially AI chips, and the way we think about it at 3Cap, we want to invest because our LP, our investors, think very long term. The fund is 4+4. So whatever company we invest today, we want to make sure that it will still be here 4, 5, 6, 7, 8 years from now, right? So that's why we take a very conservative and yet innovative approach to actually have a lot of strict KPI to make sure that the picks and shuffle companies that we invested in falls into this particular category. So that would be the initial opportunity. But when the AI wave go, I believe that there will be opportunity on the application layer. So that would be the second stage. But at the initial stage, this is where we focus on.
What about you, Rachel?
So I'm going to, since Since Esther has talked about this, I'll talk about the infrastructure. In Southeast Asia, because of the U.S.-China trade relationships, it's been a big beneficiary for semiconductor investments, data centers, high-tech AI data centers across the board. A lot of the manufacturing plants for EV cars are now moving over. If you think about EV, there's 750 times more chips than a typical cell phone. And so we do see a lot of investments coming into Southeast Asia in a much bigger way from that standpoint. Intel, Google, Microsoft, everyone's been announcing billions of dollars every week in Southeast Asia right now, in investment into Southeast Asia. In Malaysia, Intel has been around since 1972, building up chips businesses in the country. And so for us, we're making it more intuitive and more direct, a lot larger in terms of investments. But basically, data centers, energy transition's been big. We've been investing in solar and hydro, just to kind of make sure that green energy also comes in play at the same time. And then we're looking to democratize energy in Asia, which means if Malaysia is able to sell power to Singapore, and Singapore is able to kind of utilize some of this information, under the ground or and the grid, it's probably makes a little bit more sense for us to kind of invest, and that's more direct. And another thing that we've been looking off is like the ancillaries, for EV cars, because right now, if you think about cars, it's basically a big cell phone. But that just moves around, right? And so we're looking at that as an immediate opportunity for us.
So I also note both of your funds is counting a very prominent Asian business family or family offices as your key investors. So when you're picking investments, or what's the most frequent asked questions that your family office investors most interested in?
Okay, so I'm very fortunate. My LP, my big LP is here, my partner is here. So it's one of the most prominent family in Hong Kong and richest one in Asia. And I'm very lucky to count them as my key LP. So the wave of, this particular wave of investment is different from mobile internet. And it's very different from the last wave of PC. Why is that? Because it comes extremely quickly. It curves up very, very quickly, and also the cycle is very short. What do I mean by that? It's very specific. The knowledge base that you needed for AI is significantly more specific than the knowledge base you need for, say, mobile internet investment. I'll give you an example, right? So I think all of us are investors here, so you probably heard about one paper. If I had to ask you what is the single paper that everybody heard of in AI, I think you can all tell me maybe it's a paper called Attention is All You Need by Google, right? That's the paper that everybody heard of. But if I want to ask you, what is the next 10 paper that influenced AI in the last decade? Most AI investors, they would not have heard of it, right? So AI is very specific because unless you have really done AI, unless you have really be a scientist or be part of the team that incubate AI company, or unless you have been actually doing the implementation, commercialization of AI, you cannot tell the difference between one paper and the other. As an outsider, they all look very similar to you. So the technical bar to actually be a proper AI investor, I'm talking about the deep tech version of the AI investment, is very, very high. So there's a lot of people right now hiring data scientists or AI specialists in the PE world. And it takes, 7, 8 years to train one? So that's why I think I have, or maybe coming from an industry background, we actually have a unique advantage, an unparalleled advantage, because we actually have all these great AI PhDs and talents, and they can all leverage on this platform to do the best, most technical investment that sometimes a family office, right? Because family office usually is, in this part of the world, is mostly trading property background, for instance. They don't have that kind of technical know-how. So it becomes a very natural marriage of the two. We can actually utilize each other on the funding side, and they also trust us on the AI expertise side.
Yeah, Rachel, how do you pick?
For us is what's a real life application in manufacturing. You know, we're backed by a lot of manufacturing businesses in Southeast Asia. And so basically is, you know, can we put AI into our factories? And again, you know, this is one example, right? You know, are we able to do advanced testing on some of the, you know, materials that, you know, comes in, whether it's semiconductors, which means you're talking about 7mm detection on fraud or faults, you know, or, you know, whether the systems are able to talk to each other, you know, from system A to system B, system C. You know, I think we're talking about real life application right now. And so when we're investing into AI, we're thinking about how do we deal with real life applications on a day-to-day basis. And so first, that's probably key at this point. And then the second thing of all is, you know, what is the real use case in terms of monetization? That's top of mind for every family right now. We can invest, you know, billions of dollars, but, you know, when do we start monetizing this? It looks like it's sooner rather than later at this point, especially when we, you know, roll it out in our factories. And so it's been good and encouraging for us.
Yeah, so we also just mentioned that last year we see so much capital is like rushing into this field. So we definitely see some of the top stellar company already reaching very high valuation. So how do you pick the right pick or how to avoid casualty?
As I mentioned, at different stage of the investment, if we look at different kind of the different categories. I think AI 2.0, in the era of AI 2.0, we just see the dawn since ChatGPT last year. So we're still at a very early stage. So at this particular time frame, looking at picks and shuffle is the right strategy. I know that this is semi-controversial because I know a lot of us here is actually looking at application layer. I'm not saying application should not be looked at. However, I'll be extremely careful because when the marginal cost of intelligence is zero, right, think about it, right? I don't know how many of you actually have tried GPTs. Anybody? So GPTs allowed complete codeless application. So my 6-year-old daughter, she can actually write an APP, okay? So the most powerful programming language going forward, guess what? It's English. That's it. So the marginal cost of intelligence is zero. Think about it. What is the implication? That means that amazing applications can come up very quickly and by a very, very small team. But that also means that the valuation itself can potentially be rather volatile. Now, that is okay if you are a short-term investor. But for me, I think most of us here, we work, I started a fund. Again, the fund has a mandate. So we need to make sure that the company can sustain long-term. So at this particular point in time, investing in the underlying hardware, and which I believe there's a lot of room for efficiency improvement, is the right approach to go. So when you look at the amount of money pouring into AI last year, when you think it's 29 billion, actually I noticed a very interesting trend. The single biggest category of AI investment increase is actually in data center. Why is that? Because data center give you a relatively stable return. But data center also has its own tech barrier, right? It's not just a matter of getting chips. You also need to know how to run a cloud cluster. So right now, everybody claims they can do it, but I believe that end of this year, beginning of next year, you will start to see some casualties. And so how to discern the casualty, going back to what your question is, you need a team that has a tech background to genuinely tell who's the cat from the little tiger cubs.
What about you, Rachel? How do you pick the rise?
How do I pick? You know, we're in the venture business, and so to be fair, there's a lot more losers than winners, and I would be, you know, honest with that. We try to make sure that our losers are more than the winners from a value-added standpoint. And so we look at the technology, we look at the founder, we look at the use case scenario. You know, something like this, for example, like the translation services, you know, it's all AI, right? It's very fast, it's very instant. You know, some of these things, you know, if we're able to see the use case and the application for it, we will probably invest. But that's, again, because we're a lot more risk-averse than the others. And so, you know, there's no good answer to how do I pick a winner and who goes to the moon first. But, you know, there's obviously some ways to kind of mitigate downside in the long run.
Yeah. very glad to see we have some AI elements at our venue today. And so yeah, I want to dive a little bit to like maybe Rachel, you already mentioned a little bit. So now it's under the China-US tensions. We see like a lot of restrictions in chip imports and export, a lot of restrictions and other like chip products to a lot of Chinese companies. So like, how do you see that all the development, AI development in China right now and all the large language models like all the Chinese companies are building, or would you invest or would you avoid, or how do you see the opportunities out there?
Well, for us, Southeast Asia has been a big beneficiary of US-China trade war. We're kind of in the middle, we're neutral, or someone told me the reason why we're neutral is because we're not strong enough to be anyone's friend. And so if you think about it from that standpoint, we have to be neutral. There's been a lot of diversion from the U.S. capital to Malaysia or Southeast Asia, and similarly a lot of diversion from Chinese capital to our part of the world, purely because, one, we've got a long-established deep tech ecosystem since the 70s, but also at the same time, I think we are big beneficiaries from the fact that we have continuously invested and have been, the back end of the semiconductor space. If you think about, what has happened in the last 2 years or so, we've had, Chinese, Americans, Taiwanese, Korean manufacturers starting up platforms or factories in Malaysia. Penang has a big ecosystem over there, and again, it's not just people, but also land, cheap land, energy, clean water, friendly diplomatic relationships across the globe, and so we've been fortunate that way, and I see us being fortunate in the next 5 to 10 years or so with political stability moving forward, and so for us, I think we've been a big beneficiary and will be continuously a big beneficiary in the next couple of years. So good for us, I guess.
Yeah, and Esther, you're from like a SenseTime background. You worked there for several years, and then
yeah,
how do you?
So
you have like a close watcher for all the AI developments in China.
So first of all, the fund 3Cap does not have a China focus. Okay, so we actually invest in opportunities, prioritize opportunities outside of China. But to answer your question, I do believe that, and we've seen it firsthand. Whenever there's opportunity, whenever there's challenges, actually it brings a very unique set of opportunities. So what is the biggest challenge that we have in China right now? We're just talking about China right now, okay? Because US has imposed a chip ban to China a year and a half ago. So amongst the 4 ingredients of AI, the hardware part China is missing. But guess what? Because it is missing, it actually encouraged a very flourishing local ecosystem of chips, domestically produced innovative solutions of chips coming from China. So that would actually be an opportunity for them. And also another thing I want to point out is that whenever there's a lack of resources, the importance of engineering genius emerges, right? Think about it, why China and India? Think about the world's top engineer. It's always from China and India. Why? Because we're both poor countries. Mm-hmm. When you're poor, you need to make the most out of it, okay? So when you think about the efficiency of an NVIDIA H100, when you run in a GDX, when you run in a data center, it's around 40 to 50%. That's it. Think about it, right? All the power you need to run, according to Wall Street Journal, it's the power of Argentina, right, to run OpenAI. But the efficiency rate of the chip is only 50% at its best. Guess what? A lot of interesting infrastructure inferencing companies emerged around the world, but in particular China. They have companies that actually can fine-tune the algorithm so that we can increase the efficiency of these chips. So this is actually useful not just in China. Of course, it's applied globally. Now, going back to the fund, we actually look at these opportunities, but we don't look at this. We don't look at China-specific opportunities. However, these kind of companies is a great example on why sometimes a challenge can also become a very good opportunity as well.
So we have just talked about, we see a lot of like infrastructure, AI infrastructures, investment and building. So how far do you see like all the software wise, like or application wise, that Asians need to catching up to the global phase, or what's the opportunity out there? Or
yeah, go ahead. Okay, so the other thing that I want to add on, and thank you for the question, is that think about the 4 elements of AI. I always go into the 4 elements. The last element is the feedback loop, okay? So you have data, you have the hardware, you have the software, and you have the feedback loop. So what do I mean by feedback loop? Feedback loop is that when an algo works, why? When an algo doesn't work, can it tell me quickly why it doesn't work? So this is a very unique advantage that China actually has. Because we have a lot of population. So, and also China runs everything more efficiently than most of the world, as you know. So in China, the feedback loop is very short. In Chinese, we say the 试错成本很低. Okay, 试错成本很低. So that's why you see the great company that is amazing in operation in the last mobile internet era, such as TikTok, such as Meituan, those such as Ali. Those are all companies from China, obviously. So I think going back to where are the opportunities, China is unlikely to come up with, China will have its own version of OpenAI, because again, LLM is going to be a matter of every country will have its own large language model, right? However, am I betting on China having an LLM that can surpass the best LLM coming in from US? I'm not writing it off now. But the chances is at least it's not extremely high, right? Let's put it at that. However, I do believe that China will have amazing application layer companies. You don't need the absolute 99.9999% top algorithm to produce a top operationally AI applicable popular company. You just need 99.999 perhaps, right? So the cost of the marginal improvement is so high that maybe, I'm just saying maybe, we don't need that. So that is the China unique opportunity.
And Rachel, that like you have been talking that Malaysia has been the beneficiary of like some of the geopolitical.
Yep.
And then how do you see like general all the opportunity in AI in Southeast Asia? I know your fund is located at the border region.
For us, AI has always been, a strong foothold for us, right? Again, I think if you want to invest in innovation, you have to be open-minded about how you think about AI or tech as a whole, to be honest. And so for us, we've looked at AI as, again, we've talked about, what is the real use case scenario. Technology in Southeast Asia is probably not as advanced as the US or in China, to be honest. We don't get the same feedback loop as what you would get in China, as what Esther pointed out. But I think we're able to kind of craft it in a very localized manner. And so when you look at what we get, or what Grab, for example, uses their data for, and what Didi uses its data for, it's probably very different. Someone like Grab uses it to kind of fuel, credit into small, medium businesses. But that's using an algorithm to write out credit scorecards, which typically does not happen or is available in the local markets. So again, the way we have to look at AI as a whole, or the applications of it, is very different because our markets are just not as advanced as the rest of the world. But again, that doesn't mean, we can't do it. It's just, very different from what typically would have been invested in the US or China.
So, so my last questions about AI would be, so in the next 2 or 3 years, which of the area, maybe healthcare, electric vehicles, which area you see them like have the most synergies that would be AI would be like widely applied, or we'll see the next breakthrough very soon? Esther, maybe?
So I want to answer in 2 layers. I think that my first response is that the part of the AI that I believe will be disrupted very, very quickly. How many of you currently own NVIDIA?
Several.
Everybody owns NVIDIA.
There's actually a lot of people.
Yeah.
So I do believe that NVIDIA has been doing all the right things to capture the GPU is not meant for training, by the way. The GPU is meant for computer graphics, right? But they've been doing all the right things and developed this amazing software infrastructure called CUDA so that they can capture entirely the training wave. And now the inferencing wave, right? In the latest earning call, Jensen Huang mentioned that inferencing is the next big deal, okay? So I do agree with him because the next wave of disruption must be from the edge device, right? Rachel mentioned car is an edge device, cell phone is an edge device. You guys are going to have a lot of robots in a few years. Those are called edge device, all of them. Even human being. In a few years, you can implant a chip in your brain. Human being can be an edge device as well. So the need for inferencing will explode, for sure. By that time, then I think right now there's a lot of potentially very interesting AI chip company that specialize in edge device that potentially can challenge NVIDIA. I'm not saying NVIDIA is going to drop its sales. The sales is not going to go down. However, the market share right now is 95%. That number is bound to go down in the next few years, for sure. Because we are looking at some very interesting companies right now that is en route to potentially disrupt that. So that's my first layer. And second layer is that going back to, in terms of the sector the edge device can disrupt, I do believe that medical is potentially one, and also is education. And the reason that these two are the sectors that I believe will have the most disruption is because currently these two are the sector with the most inequality. Think about it. A doctor in Asia versus a doctor in Bangladesh versus a doctor in, I don't know, like somewhere in Africa. With the help of AI, they can have the same access. So can you imagine the delta from the guys in Africa or South America or some parts of Asia? So I think these two are the sector, because the delta is so big, the disruption is also the biggest.
Rachel?
For me, it's a very practical answer, which is everyone is racing to the most technological advanced semiconductors. So how about the semiconductors that have nowhere to go, right? So it'll go into EV cars. And so if you think about it, we now actually, our phones, our watches, iPads are all electrical. And so with oil prices where it is and, everyone looking at green energy, I think EV cars is just a very natural, as prices go down, it's probably the biggest beneficiary from, the race to the bottom for semiconductors. And so therefore, it's probably the most likely winner from this.
Okay, we're running out of time, but one last question. We ask every panelist today, what's the most investment you're most proud of, or the most successful investment you ever made? Esther?
Personal or professional?
Can be either.
I would consider this a personal investment, even though some of you can dabble in this. So around 10 years ago, I read a random article on Facebook. They talk about a company, a guy, a 27-year-old guy, that actually become the largest drug smuggler in the US with 27 million transactions a month or something. And then the operation the company he operates is called Silk Road. And then the medium he used is a thing called Bitcoin. So I was very curious. I said, what is Bitcoin? So I deep dive into this. And so I spent a few $1,000s 10 years ago to buy some Bitcoin.
Very interesting story. Rachel?
Okay. Mine was more passion and fun and stupidity, I guess. In the past, when I was in Hong Kong, and I have a friend there called Nick, we used to do a lot of whiskeys. And then at one point, I started being really big into buying whiskeys because it was just fun. And also stupid, I guess. So then I ended up buying a bunch of very rare whiskeys over the years. I did not know whether it was any good, but recently I was told by the Diageo guys that it's now 20-fold, and so those bottle of whiskeys have now gone back to the auction houses to be sold. So that was really it.
Rachel, Esther, thank you so much.
Thank you.
Thank you.
Please welcome to the stage Suyi Kim, Global Head of Private Equity at CPP Investments, Raja Mukherji, Managing Director Credit at Apollo, and Isabelle Scemama, Global Head of Alts and member of the Management Board at AXA IM, for a conversation with Bloomberg's Eric Schatzker.
Hello again, everyone, and thank you for staying through to the very end of Bloomberg Wealth. Delighted to see you all. This panel is a bit different. This is a panel of investors. We haven't done this yet today. And as you've probably seen, it's a panel about investing in private markets. I have brought you subject matter experts. As you just heard, Suyi Kim is an overseas private equity at CPP IB. Raja here is a managing director in private credit at Apollo. And Isabelle does private credit, does private equity, does real estate, does infrastructure, overseeing alternatives at AXA Investment Management. And so they will bring you, the investors among you, insights from fellow investors. And since it is a conversation about private assets, why not begin with a poll, everyone? Get out your phones. We'll bring up the QR code once again. And the poll itself, how much of your investment portfolio should be in private assets? Is the right answer A, 10%, B, 25%, C, a third, or D, half of your portfolio? Folks, please register your votes. And after an initial round of questioning here on the panel, we shall reveal the results. I thought a good way for us to begin this discussion would be with an overview of the asset classes our panelists are experts in. And so, Suyi, I'm going to ask you to begin by sharing your perspective on what's happening right now in private equity. As many people in our audience surely know, private equity is in a bit of a tricky spot. Exits are challenging. There are maturities coming due on loans that were originated at much lower rates. Leverage is harder to get, and that's just the beginning of what private equity is dealing with. As an investor in private equity, Suyi, what's it like?
Thank you, Eric, and thanks for having me. It's an honor to be here. I've been in private equity industry now almost 25 years. Yeah. This is an industry that has grown significantly and dramatically over the time period. And this is an industry I am still passionate about for a couple of reasons. Somebody said the private equity industry is a governance arbitrage. We all know that the performance of the businesses very much hinges upon what the governance that you have for the businesses. Private equity, buyout strategy in particular, has strong governance in the company, is an owner who's driven to make 2.5 to 3 times money in 5 years, and they deliver it. Yeah. Private equity is also, as an investor, is an asset class that if you do more work, if you do more diligence, you can make better informed decisions. Hence, you increase your chances of making higher returns. So I call this an honest asset class. I tell our team, the more work you do, have more conviction, it's likely that you deliver. Yeah. As Eric mentioned, I run global private equity business at CPP Investments. We have currently about 156 billion Canadian dollars of private equity assets underground. That's about 120 billion US dollars. That makes us one of the largest, if not the largest, private equity investor in the world. Over the last 10 years, we have generated more than 15% net return. That's after all the expenses, all the allocated costs, as you may know. So this is an asset class that performed for us long-term in a very and a stable and high-performing and beating the public market equity returns that we have seen over the period as well. Yes, as Eric mentioned, the industry is going through some adjustment. Over the last 2 years, the activity has really slowed down. As we all know, 2022, with the inflation, rate went up, rate hikes, and the people, buyers and sellers, had different views about the valuation of the assets that they own. Sellers did not want to sell. They didn't want to sell it at a discount to the carrying value of their assets. Buyers thought that with the new rate environment, they didn't want to pay the multiple that they saw the years before. What I have seen from my own portfolio as well as in the industry is that we have seen the underlying assets growing at a very healthy pace. We have seen for the last 2 years across all my asset portfolios, top line and bottom line growing double digits. particularly strong growth for our US investment, which is more than 60% of the entire private equity market, and same for my overall portfolio too. So over the last 2 years, I would say that the price discovery, I feel like that discovery has been coming to close to an end. The price expectation gap has been narrowed, so I'm seeing the activities picking up. Eric, you're also right that people call the exit drought has been there. Yeah? Given this buyer and seller valuation gaps, activity has not been happening. IPO market was on hold. I do also see the signs of that opening up as well. In our own portfolio, just last month, we signed an agreement to sell one of our assets called Dorna Entertainment, which is a MotoGP, it's a motorcycle racing company, to sell it to Formula One, Liberty Media. That was a strategic exit. We also, 2 weeks ago, IPO one of our portfolio company called Viking Cruise, which is a river cruise company. And that was one of the biggest IPO in this market, and it's trading really well as well. So I do see signs of that opening up too. One last point, there's another way of the exits private equity industry has created, and that we are one of the pioneers, which is secondaries. And secondaries has been firmly, I think, getting in their position of providing liquidity to the LPs as well as GPs in the private equity industry.
One quick question for you, Suyi, before we move on. Private equity isn't that old an industry. It dates back to the bootstrapping of KKR in the mid-'70s. And it's gone through several eras. We are obviously long past the days when there were so many inefficiencies in the market that without very much effort, private equity managers could crank out 30 and 40% annualized returns. But if you look at what you're doing and where you think the industry is headed, particularly with interest rates where they are and where they're likely to be, are the days ahead for private equity better or worse, perhaps, than what we experienced in the aberrant years of ultra-low rates between the GFC and the pandemic?
Yeah, you're right. That with a very ultra-low rates, private equity had a great time in compounding and getting multiple expansions. So there are reports out there talking about the returns. Half of them came from the multiple expansions. But it differs depending on what type of investors and which managers that you're looking at, what type of deals you're looking at, right? Some multiple expansions without the rates decrease and ultra-low rates, you can still justify. If the company grows their revenue from 3 times and 4 times, and then you have a better position in the market, can you justify higher multiples? I do think yes. The bad news is that going forward, for you to be able to do that and without less reliance on the multiples, the work that you need to do to create the value of the assets that you own will be harder work. You just need to put into the harder work to get to the probably similar result, or overall industry getting to that result will be hard, and it will be more differentiation between people who are really putting a lot of work to do the value creation versus people who in the past just relying on some great macro tailwind.
Raja, it's your turn to talk about private credit. There is discussion, shall we say, in some corners of financial markets that private credit is in a bubble. Heavens. Too much capital chasing too few opportunities, documents getting looser, and some shenanigans going on, the beginnings of what appears to be creditor-on-creditor violence in private credit, which wasn't supposed to happen. So tell us, what's going on?
Well, thanks, Eric, and it's a real pleasure to be here, and thanks for your time. I think the way to answer Eric's question is to really point out that there was one missing answer in the responses you were given. It should have been the fifth option, 90% of your portfolio in private assets. Jokes aside, I think before I start, for us at Apollo, today we manage about $450 billion in dedicated private credit assets. And most of that actually is geared towards higher quality investment grade, senior credit. And we ask ourselves daily the same question, and perhaps to you as well, is that why should we have $1 of a public market instrument in our portfolio? Do you really need to own one? And if you go back and you answer the question by saying that, well, public markets did serve a very important part of our portfolio allocation. It served as a good beta. It served as a good means of liquidity. But it had a lot of tailwinds that we have seen over the last 10, 15 years. A lot of that is unwinding or has unwinded, and we may not see that in the future. So what does the private markets really do? It's really become a home of massive amounts of liquidity that have gone from various aspects of our markets and that has become a home. And that also leads to the fact that there's no real price discovery. So as an alternative, the way we answer the question is that alternative credits, alternative assets, alternative private credit is probably one of the few areas where you can actually generate alpha. And you can do that by actual underwriting of a certain asset or asset class, and you can generate alpha. Now, we don't think that's the possibility of that in the public markets exists today. As I said, it's really has become a home for liquidity, and you really can't control your purchase price. As one example, S&P 500 today trades at 23 times. Dividend yield less than 4%, you have inflation 5-6%, and you have interest rates at around 5%. Now, the question is that, for you to go into that, at today's price, that purchase price matters. And what we can do in alternative and private credit is that we can be patient and we can source assets and we can underwrite to generate a very healthy return. Now, as I mentioned, of our $450 billion, we are mostly invested in the senior part of the capital structure. And we chose to be part of senior credit. And there's a reason for it. If you go back in history, private credit and where we are today really came out of a few factors. Really came from debanking in the US, which really saw the brunt post-GFC. You've seen it in Europe. Asia, it's much less. Asia, it's not the regulators that are telling banks to get out, but companies are requiring more sophisticated financings that the bank market can't address today. So if you think about the LBO market, a $5 trillion market, banks were told to get out. And banks are underwriting companies, LBOs at 6 times debt to EBITDA or cash flow metric, and spreads of 400. Now, that's a great market to be. For us, we can generate assets in the low teens, staying at the top of the capital structure, and we can actually control our exit through those instruments. Now, secondly, a lot of the banks have gone out of very asset-intensive operations business. Think about trade finance. We bought BNP's trade finance a few years back, and that has given us the power to originate a lot of the trade finance loans, to a lot of middle market and large corporates. Third, we bought Credit Suisse securitized business called Atlas. That was last year. And that's really an investment-grade warehouse for ABS products. So all of these opportunities that were sitting on banks' balance sheets really are private assets that have come out to folks like us or others in the private credit market, where we can generate investment-grade instruments at high single digits and also secured lending in the low teens. And my final point is that why I feel optimistic about private credit going forward, despite all of the bubbles, and I'll come to that in a second, is that you have Basel III coming. And Basel III is going to have additional capital standards for banks, especially in securitized product. Asset-backed securities, you talk about aircraft leasing, lending to consumers, lending to autos. That is a $20 trillion market, and we haven't even touched the surface. So that just tells you that today, while private credit on paper, people say it's between 1.5 to 2 trillion, you're talking about another 20 trillion of possible assets that sat on banks' balance sheets that is going to come. So, finally, I think the most important thing is that purchase price matters, and it'll matter more in 2024 because we expect some managers to make mistakes. You're coming in and buying assets at the top of the market, whether it be equity or real estates, and even for private credit. There's going to be safe alternative private credit, there's going to be risky part. And you just got to make sure that you allocate your portfolio to have the right balance.
Raja, very quickly, at least in the US market, where private credit arguably originated, it is mostly, and you touched on this, LBO financing. I think that that's something that many people don't actually realize, that 95% of the loans that are originated are there to finance leverage buyouts. Is that the same here in Asia, or are you disintermediating banks in different ways?
So I think that's a very good question. Banks, obviously, that was banks' bread and butter for a long time. And to just give you one example, in the US, 90% of all corporates that have more than 100 million in revenues are actually private companies. So for companies to stay public, the incentive of that has come down a lot because private companies can now access capital that they would go to the banks, right? So that disintermediation has really seen kind of, a large proportion of that in the US, and we are seeing in Europe. Now, as I mentioned, in Asia, you do have sponsored activity, you do have LBO financings, but clearly, deal activity has been low in the last few years. But nonetheless, I think what has happened in Asia is that a lot of the domestic capital markets have become increasingly sophisticated. Hence, corporates are looking for much more sophisticated solutions that banks either can't provide, and that's where private credit can come in. And here we can really do large deals, and especially in Asia, people talk about that, well, the deal sizes are small. You can do large deals in Asia. And as one example, Eric, just a few months back, we did a large transaction for Panasonic. We actually carved out one of their businesses that made automotive cockpit systems, and we structured a private credit wrap around it. So I think those types of opportunities are going to be what we see here. It's not that banks are leaving or being told by regulators to exit, but it's really that the sophistication of the capital markets and borrowers here are increasing at a rapid pace.
Isabelle, before we turn to you, let's reveal our poll results. Everybody, remember, it was how much of your investment portfolio should be in private assets, and the winner is 25%, but only by a hair. Some of you think, a good number of you think it should be a third, and as we go down, it gets, as you can see, 10%, a quarter of the audience. Very few of you think you should be dedicating 50%. Isabelle, I'm not sure whether that's good or bad news for you, I suppose, in some respects.
My answer would have been 1/3.
A third.
So I think I share the same views as most of the audience. So yeah.
You have a broader overview of private assets in your role at AXA Investment Management, private equity, private credit, as I mentioned, and you could touch on those, but also please share with us some perspective on real estate and infrastructure.
So yes, private asset globally, I think for most of the investors we talk to, yes, the target is around 1/3, and it's a balance and a mix of private equity, real estate, infrastructure, private debt. But the way we look at all those asset classes is more looking at the underlying trends, what are our convictions on the markets that will drive our investments. So just to echo a little bit what has been said, and notably on private credit about the bubble. I'm not sure there is a bubble, because when you look at the dry powder available for private credit, it's below what is needed by the dry powder available for private equity. So we have still a mismatch. Having said that, you have some capacity from the bank. The CLO market was closed last year, so more capital has been and more transactions have been done with private debt. The CLO market reopening, it will rebalance and readjust. That's the way the markets are working. But to come back on the way we are looking at all those asset classes, we are driven by convictions, by underlying trends. So, for example, bank disintermediation. We were talking about credit, that's a big one. And of course, this drives the capability to generate returns, notably on direct lending, as I've said, because there is some translation between the BSL market and the direct lending market. But it also offers a lot of opportunity, bank disintermediation, notably on, for example, the strategies where we can access to bank portfolio and do what we call significant risk transfer, so buying a first loss or second loss of a bank portfolio in order to, and we generate double-digit return thanks to that, getting access to a pool of loans that will be very good quality. Another type of deal that we are doing being based on bank disintermediation is also, of course, CRE debt. We have one of the largest CRE debt, so real estate debt franchise, and we are at a time where, and we can talk about real estate, where values have adjusted on real estate, maybe more or less depending on which kind of asset class, which kind of geography, but you are entering the CRE debt market with very low level of, or at least valuations that have adjusted, and a market that usually is dominated by banks. In Europe, banks represent 2/3 of the CRE debt market, a little bit less than that in the US, because you have insurance companies, you have the CMBS market that has always been more active, but A market that remains dominated by banks. Banks are off because of everything we know, notably Basel III, but also because of the hits they have taken on real estate. So it's a perfect moment. So on credit, you can do, yes, this banking disintermediation is offering a lot of opportunities. We like the healthcare sector. That's one of our preferred sector. But we invest in healthcare through real estate. We have one, if not the largest, life science franchise in Europe. So we build and we develop buildings, laboratories in partnership with universities, with medical centers in order to offer the premises needed by all those startups and players in the healthcare sector. That's something within the real estate segment that is performing very well. We have been very active in the medical offices, in hospital, in real estate. We are also investing in the healthcare sector with our infrastructure division, where we have invested in laboratories, for example, that provide diagnosis and tests. And this is also something that is performing very well. We are invested in healthcare in private equity with a strategy that is targeting the markets where you have big populations, so more emerging markets. So we source companies in Europe or in the US, but with that are developing molecule or devices or vaccine that can address the big part of the population. So they will address pregnancy disease, or they will address vision problem, they will address diabetes. And so we distribute and we make the returns thanks to the high volume. So that's also a very strong bet. But all this is supported by this conviction on healthcare. And of course, when we invest in private credit, healthcare is also a very, very strong focus. And there is other trends. Of course, digitalization is one of them. That's a big focus when we invest in data centers, when we invest in fiber. That has been, those sectors have overperformed over the past years and supported by digitalization trend. So that's the way we look at things. And if because we have talked a lot about private equity and private credit, but if we talk a little bit about real estate, that is the asset class that has probably been on the headlines and not always for the best over the past months. When I look at our portfolio, offices represent less than 30% of the portfolio. And of those offices, they are generally they are European. We have no office exposure in the US. And it's more in the US where offices are under big pressure. But even in Europe, when I look at the rental growth we have generated with the office portfolio, it was 10% last year. So yes, there is issues with offices, notably those that are not well located, but the best asset, well located, continue to attract a lot of tenants and to generate good returns. But if I look at the rest of the portfolio, of our real estate portfolio, we have overweighted over the past year logistic, residential, but also student accommodation, senior living, and all those sectors that benefit from very strong underlying trends, very strong cash flow, a lot of demand. So yeah, the rental growth overall on the portfolio, on the real estate portfolio, was 10% last year. So I'm not telling you those portfolios are immune from interest rate adjustment, of course, but it's true also for private equity. All the assets that are capital intensive, they have, they can be, and they are affected by the cost of financing that have been multiplied by maybe 3 to 4. But when you can generate cash flow and good cash flow growth, it can compensate or overcompensate for this adjustment. And maybe the difference between private equity probably and real estate is the fact that on real estate, because we have a lot of open-ended vehicles, because those asset classes are also owned by insurance companies that are forced to put those assets at mark-to-market, there is valuations. The hit has been taken within the portfolio. So when we show you a portfolio, this is at values that have adjusted. It's more challenging in private equity that is structured generally more through closed-ended vehicles and where you don't have the same valuation system in the market. So but at the end, the performance cannot be immune from the level of interest rate and the cost of financing.
I'm delighted that you brought up these two things that are so elemental to any form of active investment like all of you do. And I'm curious to know whether there's some agreement among our panelists on high conviction and megatrends Isabelle here mentioned healthcare, for example, and within logistics, of course, this sort of trade reorientation. We've heard a lot today about the energy transition. We've also heard about artificial intelligence, in fact, just on the preceding panel. Raja and Suyi, do you share any of what you heard from Isabelle in terms of high conviction, and how are you applying it in the investments that you're originating?
Private equity, again, as I said, it's the highest risk and return asset class. Within private equity also, there are different level of risk-taking. If you go to the early stage ventures, it's a higher risk and return. Buyout, less so, that you have more predictable cash flows. So private equity players has been very good at navigating, finding the best opportunities to make 2.5 to 3 times money in 5 years. Again, it's a big challenge. So for the last 10 years, we've invested a lot in enterprise software. Yeah? That is a digitization trend that I think we are still in the middle of that. Right? So digitization, I think, it went up to now super speed with the AI as well. There are lots of other infrastructure, whether it's electric generations or the transmissions or data centers, all needed. But also, our business itself should be ready to be able to utilize all of those. So I do see the digitization across the world, whether you're buying a company that's providing vertical or horizontal enterprise software solutions or IT solutions businesses. I just came back from India. Right? So India is one big country where they provide a lot of outsourced IT services. Yes, with the AI development, it could get interrupted, but not all IT services businesses are the same. There are the businesses that are focusing more on migration of your data to the data lakes and helping the companies to be able to implement going cloud or implementing your data analytics as well. So I think there is a digitization, there's one big trend. I do agree also on the healthcare side as well. Private equity, when you look at underlying portfolio companies that we have, these technology and the healthcare services are the 2 biggest proportion of the portfolios. We all know that globally the aging is happening in the developed markets and even some developing countries as well. And the healthcare needs to continue to innovate, and there are players that are doing better and better, and then market share growing and overall market growth. I think that it will continue to be there.
What about you, Raja?
Sure. So I think from our perspective, what we feel really passionate about is really like 2 high conviction themes. One is, as I mentioned, we have chosen to invest most of our private credit in the senior part of the capital structure, but more importantly, with large corporates. And I'll give you an example, which actually just was announced today. We are lending more than $10 billion to a joint venture with Intel Corporation to build one of their semiconductor chip plants in Ireland. And this is a very unique financing because it serves a couple of needs for Intel. They wanted equity treatment, they wanted efficient cost of capital, and a long-term partner. So I think the theme is that a lot of these corporates that used to deal with banks, especially for large financings, they are looking to enter into partnerships with someone like Apollo who can come in, and even with a private credit or a private alternative asset solution, that we are providing them with a solution that's going to take care in the long run, 5, 10, 20-year transactions that we enter into some of these large corporates. We did a multi-billion-dollar deal for AT&T in the US. We did a multi-billion-dollar deal for ADNOC, similar one for Anheuser-Busch in the US. So all of these large corporates and their boards are coming to us and saying that, well, you can solve for X, Y, Z, and you can also invest with us for the next 10, 15 years. And for all these investment-grade companies, we are creating assets for our global wealth clients in the high single digits. Now, that to me sounds really, really attractive. Secondly, I think the other theme is the theme of platforms. And by that, I mean that, Apollo, we have invested $8 billion of our capital to invest in 13 platforms. And these are platforms that generate senior credit every day. You talk about, aircraft leasing, lending to planes, trains, automobiles, consumers. And here we are generating, again, top of the capital structure at a very good, attractive return. So I think these are kind of the 2 primary themes that, we are looking to create. And a lot of these goes into, our semi-liquid perpetual products that are really geared for our wealth investments, that you actually get diversity. And a lot of these, what I call top of the capital structure, super safe, large corp credits at a very attractive rate versus the public markets.
I'd like to know a little bit about how geopolitics is affecting your investment decisions. It's pretty hard to ignore geopolitics sitting here in Hong Kong. In some respects, what Roger just told us about the deal that Apollo has done with Intel, you know, in some respects, that is a function of geopolitical trends. Intel is a beneficiary of very generous subsidies from the U.S. government, and that is creating opportunities for Intel to do things with its portfolio of fabs around the world, and by extension, creating an opportunity for Apollo. Isabelle, why don't you tell us, how is geopolitics affecting the way that you look at the investment decisions you're making at AXA? Are there things that you are doing because of geopolitical trends, and things perhaps that you're also not doing because of geopolitical trends?
But when you are looking, I think we are all passionate about private assets. But the reality, I've been in this industry for 30 years, and the reality is that to adjust your portfolio, to make a transaction on private equity can take 6 months, sometimes even more. Even on private debt, it's not, the beauty is that we are not trading on a Bloomberg screen. So
tragically.
we look at Bloomberg. We use Bloomberg a lot because we have to have the reference and the public market reference. But at the end, we are investing in assets that it takes long to transact. It takes long to build those portfolio, and it takes long to shift your portfolio. If I look at our real estate portfolio, it was 2/3 offices and retail 10 years ago. Today, retail has almost disappeared, and offices is below 30. But you have to have the right calls and the right convictions. So you want to go through the cycle. So yes, we know that geopolitics is there. We know that but I didn't know about COVID. I didn't know about the Ukraine war. I didn't know about what's happening in the Middle East, even if we can predict. And this tension between China and US is also there. We know that it's there, but it can appear here and there. And you know that your investment, your portfolio has to be as immune as possible from all those risks. And so you will avoid, the way to protect from those risks is to avoid some countries that are very tricky. Of course, we have never invested in Russia. We have never invested in China either, because we were not so comfortable about our capacity to generate return there. So you have to select countries where you feel comfortable on the long run. And once again, look at the underlying trends, look at what will support your asset, whatever happens, whatever. And I'm happy to say that post-COVID, our investment convictions are exactly the same than they were pre-COVID, because those crises, what they do is they just accelerate those trends. So they are a catalyst, they are an accelerator. And so if you pick the right convictions, if you design the right pathway to adjust your portfolio, you will protect your performance, whatever happens, and even things that are a little bit unpredictable. So that's the way I would look at it. And the other thing is diversification. If you want to protect your portfolio from those risks, you have to diversify within real estate, within infrastructure, within private credit, within private equity. That's the recipe. And so, yes, the convictions and the diversification are the best protection. Now, can we benefit from those geopolitical risks? Yes. Logistics, for example, that's a booming asset class. And yes, we get advantage of the fact that we have a lot of reshoring, a lot of companies that make the decision to change their the supply chain system, and to reshore more and more in Europe or in the US. And that's something that is accelerating notably the trends on logistics, and allow us to have rental growth on this sector that is also more than double digits. So,
Raja, Suyi, are you leading into anything because of how you see geopolitical trends evolving, or perhaps leaning away from anything? And also, since Isabelle brought it up, how do you feel about China?
Go ahead. I was going for a super. So I think from our perspective, I think one of the things that Isabelle mentioned is that you really got to make your portfolios all-weather proof. And I think the way we do that is really by having a very value-oriented approach, which is why we go back to one of our tenets. It's like purchase price matters, guys. Don't forget it. It does play a very important role as to how your portfolio returns shape up and migrate. With respect to geopolitics, look, I mean, we take a very pragmatic view in terms of where we can actually conduct business, where we can underwrite assets, where we can call it an edge of what we can do. versus being completely at the mercy of policies or other regulatory aspects that we just can't quantify. And sometimes it's not a science, it's a bit of art. So I think we pick our geographies. As an example, I give you for Asia Pacific. I mean, we are open for business in Asia Pacific, but we have certain country focuses. India, Australia, Japan, Korea, clearly are some of the countries that we focus on. Now, China is, in our mind, it's just that the gravity has shifted away from China. And again, that has led to what my earlier comment was. A lot of the liquidity flows has come out of China and found home in public markets, which distorts pricing. But at some point in time, China is going to come back. I can't predict the time. So it's really a question of where are you positioned where you can actually invest with a certain level of comfort and confidence that you'll have some desired outcomes. And to the extent that those are not possible or maybe just a moment of time, that you take a step back, but you never kind of walk away because the opportunity set arises when there are market dislocation, when capital flows leaves the public markets, opportunities arise.
Suyi.
So geopolitics and regulation has become more important areas of diligence, right? And then as an equity investor and private equity investor, we run lots of scenarios. Generally, your return and investment case doesn't come with your investment base case. So with this uncertainty in geopolitics and regulations, our team needs to run a lot more downside cases and potentially upside cases as well. There are companies that has a strong moat in their own domestic market. They may benefit. Yeah. Having said that, we do not rely on regulatory benefits as in the base case, as Isabelle kind of alluded as well. This is a long-term asset class. Yeah, private equity investments, if you invest into the funds, it's a 12 years asset class. Direct investments, anywhere 5 years to the 7 years that you need to hold. We have seen government changing generally over the time in most of the countries, and tax policies changing and all of those. So do we take into account the IRA when we do the base case returns? No, actually we look at it as a gravy on top. Yeah? There are cases of this, we call the stroke of a pen risk. Stroke of a pen, we do not like those assets. There are industries that's sensitive, that on top of the national security agenda of many countries around the world, we do not like those industries. And then when you think about this upside and downside and focus on the fan of outcome that you can get in any given investments, certain countries and markets, it's challenging to make the investment case.
Could you give us a couple of examples of stroke of the pen, for example, or that last category that you just outlined about sort of sensitive areas?
So there are some of the industries that were in the past that you would manufacture out of China, you would export out to the US. You may not want to invest in the themes because the US government believes some of the industries like semiconductor is the national security areas. Not the private equity invest into semiconductor. That is actually very asset-intensive businesses, and it's hard to make, again, 2.5 to 3 times money in 5 years. So that's one of the examples. There are many other things. I mean, we talked about healthcare. Healthcare is highly regulated industry. Financial services is highly regulated industry. Telecom is highly regulated industry. Some of the niche businesses that you look at it, once the government changes the policies, your economics may dramatically change. And then we do not like to own those assets. Yeah.
And finally, and we don't have much time, regrettably, you've spent a good part of your career here in Asia, in fact, once upon a time based in Hong Kong, if I'm not mistaken. How is CPPIB thinking about China right now?
I opened our Hong Kong office. I'm our first international employee that CPP Investments ever hired. I've been based out of Hong Kong for 14 years. I've been here for many years as well. China is, we have our Hong Kong office. We have more than 100 people underground here as well, investing across Asia Pacific. China is one of the largest economies in the world. We do believe as a large global investor, it is important to understand that market. If you're not investing directly into market, which we do continue to invest in that market, but not understanding that part of the world will have impact on understanding the rest of the world, how the business is going to pan out and economics is going to pan out. So that's how we look at it.
Very good. Ladies and gentlemen, I could continue talking to this panel for quite a bit longer, and I suspect you could continue listening to them, but sadly, everything must come to an end. And that does conclude our plenary program for today. Before we thank our panelists, ladies and gentlemen, I do want to say a few things. I hope you enjoyed our program. I hope you found these sessions rewarding. And of course, I hope that you come back and see us here at Bloomberg events soon. I do want to also thank our founding sponsor, HSBC. We appreciate HSBC, your support in helping to make this event possible. For those of you who are attending the New Economy Insights Roundtable, please head upstairs to the 7th floor in the Hennessy Room. Everybody else, you can find your way out the same way you came in. And now please join me in thanking our panelists, and thank you once again for coming.